Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. Today, on the subject of financial management, we have topic discussions about the cost of capital. Okay, before explaining in more detail about the cost of capital, it would be better if we know about the definitions and the fundamental concept. Okay. Let's see the definition and fundamental concept about the cost of capital. Okay, let's start with the capital. What is the definitions of the capital? Capital is defined as the fund that used to financing in acquiring company asset and financing the operational expenditure. So, according to these definitions, that capital is actually the fund that used by company to financing in acquiring the asset and also to financing the operational expenditure. So, according to the definition, that capital is also categorized into the foreign capital, so that we call as liabilities, and also the own capital, or we can call it as equity. So if we know about capital, we also better to know about and we have to remind the subject of accounting. We know that on the subject on principle accounting principle, according to if we remind on the subject of accounting, we know that there is an equations. There is the accounting equations. As we know that accounting equations is asset is equal to liabilities plus equity. So, liabilities and equity is actually part of the capital. Liabilities and equity actually part of the capital. But however, liabilities is actually the capital that the fund that the source of fund come from the outside, or we can call the foreign capital. It means that the source of fund that come from the outside of the company. Okay, another capital is also equity. Equity is a real capital that comes from the own company. It means that for your own pocket, maybe something like that. It is the equity. It's part of the capital. Okay. The cost of capital. The cost of capital is for taking all decisions use method weighted average cost of capital. According to this information, that while we are calculating the cost of capital, that it means that to take for all decisions, we have to calculate the cost of capital is used. The cost of capital is used by method of weighted average of I mean that why we are calculating the cost of capital to take all decisions, we have to use the method of weighted average cost of capital, or we can call it as equity. We are assessing. Both of these capital liabilities and also equity, we can calculate of the cost of capital with using the method of weighted average or average cost of capital, or we can call as VRCC. Yeah. Or we can use the weighted average cost of capital, or we can call as WACC. Okay. The other information that not all capital components are calculated on the weighted average cost of capital, such as account payable. Yeah. According to this information that not all capital components, yeah, both of liabilities and also equity, yeah, according to the informations that not all capital components are calculated on the weighted average cost of capital, such as account payable. Yeah, account payable is part of the liabilities. As we know that on the liabilities there are two components. Yeah, there are two components that liabilities is comprising of short-term liabilities and then the second is long-term liabilities. Yeah. Okay. Account payable is also part of the short-term liabilities. So that's why account payable cannot be calculated on the calculations of the cost of the capital, while we are using the weighted average cost of capital. Only long-term liabilities that we can calculate the cost of capital while we are using the weighted average cost of capital. So long-term liabilities such as the not payable, yeah, not payable, yeah, is calculated on weighted average cost of capital as long as it's part of the company fixed expenses. Okay. Generally, long-term debt is an element for calculating weighted average cost of capital. Yeah. So we have to calculate as follow. Yeah. To calculate the cost of capital, we are using the weighted average cost of capital. There are three or four maybe. Yeah. There are three or four steps to calculate the cost of capital. The first, we have to calculate first about the first is we have to calculate the cost of debt. Yeah. The first we have to calculate cost of debt, and then the second we have to calculate cost of prepared stock. As we know that we have discussed on the last week that we have discussed about the stock valuations, yeah, and then the third we have to calculate the cost of retained earning, and also the last is we have to calculate of new common stock. So this is the component of the cost of the calculation where we are using the weighted average cost of capital. Yeah, the first is cost of debt, and then cost of the previous stock, and then cost of retained earning, or maybe cost of new common stock. Yeah, for the component 2, 3, and 4. Yeah, sorry, for the component 1, we have to calculate cost of debt. It means that we have to calculate the liabilities. Yeah, and then for 2, 3, and 4, if we are using, we calculate the cost of capital that comes from the equity. Yeah, Yeah, number 2, 3, and 4 is we are actually calculated the cost of capital that the source come from the equity. Okay, and then For number 3 and 4, cost of retained earning and cost of new common stock, we can call as cost of common equity. Okay, according to this information that the cost of capital must be calculated based on tax basis, yeah, because after tax cash flow, yeah, is the most relevant for making investment decisions. Okay, when we calculate the cost of capital, it means that it should be based after tax, yeah, after tax basis, yeah, because after tax cash flow is the most relevant for making investment decisions. Okay, that is information about the fundamental concept of the cost of capital. Okay, let's continue about the how to calculation about the cost of capital. As we mentioned before that there are three or five steps to calculate the cost of capital. The first we have to calculate first about the cost of debt. Yeah. Okay, let's see the definitions of the cost of debt. If the company use the bonds as the instrument to get funds from long-term liabilities, so the cost of capital is equal with KD, yeah, with KD, or we can call as yield to maturity. Okay, do you still remember about the KD or yield to maturity when we study discuss about the chapter of the bonds valuations? Yeah. Okay, we know that the bonds is hutang obligasi, ya, hutang obligasi atau hutang surat hutang, ya. So it means that we are calculating about the liabilities, yeah, the cost of debt. On this case, that we have to calculate cost of debt. Yeah. Okay, the cost of capital is equal with KD, yeah, or yield to maturity, or total return that shareholder can expect from their investment in bonds. Yeah. Okay, let's take a look at this example why we are using the calculations on the bond, the cost of debt. Okay, let's see the example. The company issues the bonds with coupon interest rate 10%, and then par value, yeah, and then par value of the bonds is $1,000. It held to maturity 5 years. So the bond is sold with price $1,000. So the calculation of the cost of debt, how much the cost of debt from this example. Yeah. Let's see the solution how to calculate the cost of debt according to this information. Yeah, according to the case of the example ones, yeah, we know that we have to calculate first about the I. Yeah, we have yeah. Do you still remember that we are that we studied or discussed about the bonds? There is the interest rate. Yeah, interest rate that we have. Yeah. We have to calculate interest rate first. We know that the equation in interest rate is M, yeah, multiplies with coupon rate. You know that M is par value. Yeah, according to the case that par value has amount $1,000. Yeah, then the coupon rate is 10%. So the amount of interest rate is $100. Yeah. After that, let's input our the equations that we know that we have to find the KD. So this is the calculations of PB. Yeah. The calculations of KD. We can use the equations. We can use the equation PB. yeah, bonds valuations, yeah, is equal I, then multiplies with the table of the present value in interest factor annuity, yeah, and then point KD, and also with the period of and period, yeah, and then plus M multiplies with the table, yeah, the table okay, plus M here that is par value multiplies with the amounts or the number that we found on the table PPIF or present value interest factor with KD, yeah, and also with number of period, yeah. So we know that according to the case on the example, we know the amount of bonds is 1,000, yeah, $1,000. Just input the amount 1,000 into PB, yeah. So we have to find out the KD, yeah, the KD or yield to maturity, yeah. So just input the amount that PB is 1,000, and then we have found that interest factor, so interest rate is 100, yeah. Then we have to calculate with multiplies, yeah, by multiplies with the amounts that found in table PPIFA, yeah, and then plus also par value. We know that the par value amount is 1,000 rupiah, multiplies with the table, the amount on table, amount that we found on the table PPIF, yeah, with KD with period of 5. So the KD is the result of KD is 10%. So how we know that the KD, yeah, the KD here is 10%, is actually put, or we calculate the equations KD, yeah. KD is equal YTM, yield to maturity, then equal to Y plus, yeah, fair value less than amount of bonds divided by periods or years, yeah, and then of the M par value plus 2 multiplies with amounts of bonds divided by 3. Okay, so the result, yeah, after we put the amounts of each amount, so the result of the KD is 10%. So in this case, yeah, on this case, we have calculate, yeah, the cost of capital. Sorry, the cost of debt. I mean here, the cost of debt is 10%, yeah, or KD 10%. Okay. Yeah. Okay. Cost of debt is debt before tax. Yeah. Okay. According to calculations, according to that information, that why we are seeing the weighted average cost of capital, we have to calculate. Yeah, we have to calculate or to separate that KD must be less, must be less by tax. Yeah, it means that KD is cost of debt before. Yeah, it means that KD that we have calculated on the case 1 or the example, KD is actually cost of debt before tax. Yeah? On the other hand, that in the calculations, yeah, that weighted average cost of capital, yeah, is more relevant using cost of debt after tax. Yeah, you see after tax, or you mean after tax cost. So if the KD that we have to less by the tax, yeah. So just example like this, KD is 10%, and then tax, for example, 15%. So the cost of debt after tax is 10%, and then multiplied with 1 less 15%. So the amount of the cost of debt after tax is 8.5%. Yeah. So this is the amounts, the percentage of the cost of debt. Yeah. The cost of debt after the cost of debt after tax. Yeah. It is considered that the debt will arise interest expense. Yeah. Okay. Let's see the information that it is considered that debt will arise interest expense which affect decrease in the income tax. Yeah. According to this information that we know that we when we are using the debt, yeah, it is considered that debt will arise interest expense, yeah, which an effect decrease the income tax. Of course, that when we are using the debt, so there is an interest, and the interest will have an effect to the income tax. Yeah. So it can be concluded that the using of debt can decrease the tax payment. Yeah. Let's see the calculations or the other example. We have the case 1. Yeah, we know that in the case 1 here is the company use all of its own capital of 100 millions rupiah. Yeah, that is with this the other information that they have information about it is the statement of the income statement. Yeah, the income statement. Yeah, you know that this information that sales amount is 200 millions rupiah, and then less with COGS. So the result of the sales less cost of goods sold, the result is gross profit. The gross profit is 100 millions rupiah, and then less with operating expense, yeah, or other overhead and so on, with amount 20 millions rupiah. So the result after that is EBIT or earning before interest and tax, with amount 80 millions rupiah. And then after amount of EBIT, earning before tax, we have also should be less with interest expense. Yeah, since the company use all its own capital, there is no liabilities, or because the company use own capital. Since the company use own capital, there is no interest expense. So we try in interest expense is 0 here. Yeah, and then the EBIT, the amount of EBIT, earning before interest, less interest, 0. So the the result is earning before tax. Still the same with 80 millions rupiah. After that, earning before tax, yeah, also is this the amounts that based tax basis when the company should pay the tax. The tax basis is come from the earning before tax. This is the calculations for the tax. Since the tax is 15% at that such example, yeah, the tax is 15%. For example, so the tax is amount the amount of tax is 15% multiplied with 80 millions rupiah. So the amount of tax 15% is 12 millions rupiah. So the earning before tax and then less with tax, yeah, the result is earning after tax. The result of earning after tax is 68 millions rupiah. So in this case, we have the conclusion that when the company use all its own capital, it means that there is no interest expense, there is no cost of debt. Yeah, okay. And then the other case is case 2. Yeah, let's see the case 2. Yeah, the company used the capital 100 millions rupiah. With such amount include 50% of debt with interest 10%. Yeah, and the rest is own capital. Yeah. So according to this information, that in this case that the company when they using the capital, there are two types of capital. The first, the company use a debt, yeah, yeah, amount 50%. Sorry, with the amount is 50% of debt. Yeah, 15%, 50% of debt with interest 10%, and the rest 50% using own capital. Yeah. So let's see the statement of this the income statement of the company. There's the information about sales 200 million rupiah, and then less of cost of goods sold 100 million rupiah. So the result is gross profit is 100 million rupiah. After that, the gross profit less by operating expense or other overhead and so on, which amount 20 million rupiah. So the result is earning before interest tax. Yeah, and then since the company use the debt with 50% with interest 10%, so the interest expense. We have the interest expense with 5 million rupiah. The amount of 5 million rupiah is come from the calculations when the company use 50% of capital. Yeah, so the amount of capital is 100 million rupiah. So the fund or the capital from debt is 50 millions, 15 rupiah from debt, and interest is 10%, then multiplies with 50 million rupiah. So the amount of interest is 5 million rupiah. Okay, so the amount of interest is 5 million rupiah. The earning before tax less with interest expense, so the result is earning before tax. The amount of earning before tax is 75 million rupiah. Okay, the 75 million rupiah is a base tax. Yeah, tax basis that the company should calculate the tax. Yeah, since the tax is 15%, so the amount of tax is 11 million 250 thousand rupiah. So after that, we have the result earning after tax with amount of 63 million 750,000 rupiah. So if we compare about the case 1 and case 2, case 1 company use all capital by using own capital. On the case 2, the company use capital, not only the own capital but also the debt. Yeah. So let's see the comparisons. Yeah, after we have the case 1 and case 2. Yeah, we know that by using debt, yeah, on the case 2, yeah, we can save the tax payment of 750,000 rupiah. Yeah, where is the amount come from? Yeah, the amount of 750,000 rupiah is come from the 12 million rupiah less by 11 million 250,000 rupiah. The 12 millions is the the 12 is amount of tax that the company use all on capital, and 11 million 250,000 rupiah when the company is the tax rate. Yeah, is amount tax that company used to debt. So the tax saving will also reduce interest expense. Yeah, that we know that interest expense. Yeah, interest expense when the company not are using the liabilities, or the company use all own capital in we know that interest expense that the company use the debt, the interest expense is 5 million rupiah, and then tax saving, yeah, and then tax saving is 750,000 rupiah. So the actual interest expense is only the actual expense. So the actual interest expense is 4,250,000 rupiah. Or the cost of debt before tax, we know that KD is 5 millions. Yeah, the cost of KD before tax is 5 million rupiah, and then tax having we know that 750,000 rupiah. So the cost of debt is only 4,250,000 rupiah. Yeah. So the cost of debt is actually 4,250,000 rupiah. So if we calculate by the rate of the cost of debt, is it stated as the percentage? Yeah, cost of debt after tax is 8.5%. Yes, I have mentioned on the previous. Yeah. So the amount is the percentage with amount 8.5% is calculated. Yeah, cost of debt divided by the total amounts of debt, yeah, which is the 50 millions rupiah, or equal with KD less tax, yeah, equal KD. It means that KD is 10%, then 15%. So the amount is 8.5%. Okay, that's the calculations about the cost of debt. Yeah. Okay guys, before we continue, is there any questions? Yeah, that's the calculations about the cost of debt. Why we are, it is the first step to calculate the weighted average cost of capital. Okay, I think the explanation about the cost of debt, that is the step 1 to calculate the cost of debt, is completed. Okay, is there any questions before we continue to the next step? Okay, if there is no question, we will discuss about the cost of prepared stock. But anyway, the cost of prepared stock, sorry. Okay, the cost of prepared stock will be discussed later after that. Okay. Okay. Thank you so much for your attention, and see you on the next part of the explanation of the cost of capital. Okay, see you. Thank you so much for your attention.